U.S. unemployment rose to 4.6% in the month of November. This is the highest read on unemployment since September of 2021. Payrolls showed a gain of 64,000 in the month of November, but in October we saw a loss of 105,000. Now this is the exact setup that forces the Fed into a credibility trap. Cut too much, you risk inflation credibility, but also cut too little and you risk a labor slide. At the moment, we're not debating a recession print. We're actually debating whether or not we're in a hiring recession or entering one at this very moment. And how quickly does that turn into layoffs? So that leaves us today with a few questions that need to be answered. First, is the labor market actually cracking? Or are the headlines just being distorted by the government shutdown and statistical noise? In order to get that answer, we first need to find out what is actually driving the rise in unemployment. Why can job openings rise while hiring and quits also fall? What's the one metric that can let us know if things are actually turning? Once we figure out those answers, we then need to ask ourselves, what does this do to the Fed's path? How does this affect risk assets? And does this change our outlook for interest rates going into 2026? Before we get into it, I have a question for you guys though. Do you think this is going to be a real slowdown, or do you think this is just some sort of statistical mirage that'll wash out in the next few months? Also, if you like the content so far and find any of this interesting, go ahead and leave a like. So in order to figure out where we're going, we have to figure out where we're at. We just got out of a government shutdown, the longest in US history, that's causing a data disruption. So things like unemployment, inflation, reports like that are being delayed, or we're getting partial data in that regard. This disruption is lifting unemployment and suppressing payrolls. And all this is happening while the private sector is sitting in a low hire, low fire, freeze environment right now. Since data has been delayed, we need to go all the way back and start looking at October payroll numbers in order to get a better idea of what is actually going on here. October payroll numbers were heavily driven by 162,000 drop in federal government employment, with federal employment being down 271,000 since January of 2025. So now that we understand what caused the drop in payrolls in October, we kind of get a better idea of what the big driver is that's causing that uptick to 4.6% unemployment in the month of November. Most of this is coming from the public sector. The government shutdown disrupted the distribution of surveys going out and forced the BLS to skip the release of October's data. So that's going to raise the noise level within the data. So the drop in federal government employment payrolls is causing the unemployment number to increase, and this is just normal unemployment dynamics. We're still seeing some of these formal federal workers still searching for employment throughout the labor force. And this right here is what can lift unemployment from 4.4%, which was our last read, up to 4.6% now. So even though we're not seeing any mass layoffs right now, we're still seeing low confidence within the labor market. Quits are low, hiring is weak, and workers have stopped moving. And these are the dynamics that make a labor market feel stale. And a stale labor market is what feels bad for everyday people like you and me. So with unemployment jumping to that 4.6%, what is directly hit? First is going to be our rate expectations, and secondly is going to be our small business hiring. Let's start with the rate expectations. We can expect to see the Fed shift focus from inflation back towards the labor market. And we've kind of already seen this pivot, and the Fed has kind of hinted that this is where they're shifting focus already. If you want further explanation, go ahead and check out last week's interest rate video. But with that, I would expect the Fed to remain cautious on this labor data because there is a lot of noise. So I wouldn't expect for interest rate cut expectations to explode in the near term. Moving on to small business hiring. Smaller establishments are the first ones to begin cutting their workforce when demand looks uncertain and financing is tight, like we're currently seeing right now. I would say that small business hiring is going to be our canary in the coal mine per se. We should be looking at them, seeing how their hiring numbers are going, and that's going to let us know whether or not we are in trouble. If small businesses are holding up, the rest of the labor market is probably going to fare well. But if small businesses start cutting, things can start to get pretty dicey, and we may have a hiring recession. So now that we covered what is directly affected, let's look at secondary effects. Even though this shock did happen in the public sector, that doesn't mean private sector is out of the way. We do still have spillover risk coming into the private sector from this shock. And the spillover risk would translate into lower private sector confidence in the labor market, credit tightening for small firms, and reduced consumer resilience. As I scroll on the internet, I'm seeing this common theme pop up. Since unemployment came in at 4.6%, that means the Fed is going to cut rates fast, and we should expect risk assets to rally. I think it's a misconception because the unemployment numbers are mechanically inflated. With shutdown disruptions and government payrolls being delayed, that's artificially inflating the unemployment number to 4.6%. So you can't actually treat this as a clean read or a clean signal in unemployment. That noise is playing a very heavy role. Plus, we have job openings rising along with a fall in hirings and quits. And seeing that dynamic right there is more consistent with mismatch and caution rather than reacceleration. And so what I'm saying there is that job openings do not equal demand strength. And lastly, small business weakness can spread. And that matters because if small businesses are cutting now, broader labor weakness can follow with a lag. I am curious to know though, do you guys think markets are too quick to turn bad news unemployment numbers into good news rate cut stories? Moving on, let's talk about what we should expect to see in the short, medium, and long-term reactions. So let's jump into what I expect to see in the short term. I define short term as the next 1 to 5 business days. So I'm recording this on Thursday, December 18th, and these numbers came out Tuesday. So we've already got 2 business days down. By the time this video is released on Monday, there's really only about 1 to 2 more business days in the short-term reaction. I would like to know if you guys see any benefit in me covering what I think I would see in the short term. Maybe I should just cut this and only focus on medium and long-term reactions, given the fact that I try to post on Mondays. So over the next 1 to 5 business days, I would expect traders to treat October and November's data with a grain of salt, with no real decisions being priced in until we get December's data. Let's move into what we expect for medium-term reactions. And I define medium term as the next 1 to 3 months. So over the next 1 to 3 months, I would really expect clarity on whether or not we're in a hiring recession. So if payroll growth stays flat and the quits rate stays depressed, unemployment numbers can keep climbing higher even without a shock. And so if we see a scenario like that over the next couple months, I would confidently say that we are in a hiring recession. I would also be looking at small businesses to become that swing factor on what is actually going on. If small firms keep cutting, the low fire scenario can break, and this would cascade into more layoffs throughout the broader economy. Over the next few months, but more specifically, January and February, I'd really pay attention to the December and January data releases. Remember, there's that 1 month lag for when data comes out. So December data isn't going to come out till January, and January till February, which is why I'm saying that. I'm saying that because when I said it aloud, it just sounded super confusing. With November and October data being so muddied, I would expect markets to put significant weight on December and January data releases, so I would expect volatility to rise around those dates. Now let's talk about our long-term risks. I define long-term as the next 3 to 24 months. Some things that we should look out for is stagnation in the labor market. If we have a long period of low hiring and low firing, this creates a perfect scenario for unemployment to just keep ticking up slowly. And I would call this a slow bleed scenario. I would continue to be on the lookout for the shift in workers' bargaining power. If job openings do not turn into hires, I would expect workers' negotiation power to decline more than what it even is. So if we see both of those scenarios play out, the stagnation in the labor market along with weaker bargaining power for workers, I would expect to see the pressure on the Fed to intensify. Consistent rising unemployment puts a lot more pressure on the Fed to cut rates faster. So now that we laid out some risks, some expectations, what can begin to break this view that we constructed within this video? A sustained rebound in hires and quits along with stabilizing in unemployment. And that would signal that the labor market is thawing and not deteriorating. Let's talk about who all this actually affects. At the moment, I really only see large firms benefiting from this. A hiring freeze raises slack within the labor market. Let's talk about who's getting hurt. We know small businesses are definitely getting hurt. They're having to cut workforce. Another casualty of all this is going to be our young workers. Teenage unemployment jumped, which is often where weakness shows first. So what we can take away from today is that the labor market is not collapsing, but it is weakening in the places that matter first, which is small firms, worker mobility, and hiring intent. I would say the 4.6% unemployment read that came out is a warning light, not a clean recession signal just yet. I would say that this shifts risk towards assets that benefit from slower growth and easing conditions, and away from areas that are dependent on broad-based labor strength and small business momentum. Now drop your call in the comments. Do you think the Fed cuts again January 2026? Or do you think we're going to have to wait some time before we see the next interest rate cut? Lastly, I would like to leave you guys with some things to look out for in the meantime. I would pay attention to January, where we're going to have December's data dropped. I would also pay attention to inflation printouts, because if inflation comes hot, then that limits the Fed's ability to cushion labor weakness. So hopefully those numbers come in muted. That way the Fed has more leeway. And then I would definitely pay attention to the small business labor trend. I would look to see if losses start to broaden out from that small business sector. Now, if you guys made it this far, give this video a like, definitely subscribe because obviously you enjoyed the content, and I hope to see you next week.